Well, how's it going, everyone? My name is Amos, and this video is for veterans of the stock market and beginners alike. Let's go ahead and say that you've been eyeballing a company, or for future reference, if you're going to run into a company that interests you, and you're trying to figure out if it's good or not. Well, in this video, we're going to go over a quick checklist that you can refer to see if the company is worth your time or not. The bare minimum qualifications. If the company does not meet the criteria, then you know that you should probably move on for one reason or another. Now, in a perfect world, what we want is to acquire and hold long-term positions in companies that I refer to as compounders. And I say compounder because your initial investment in them, say like you put $100 into it year one, well, down the road, year 5, year 10, year 20, your money should have 5x, 20x, meaning it should have grown, 1,000% or 20,000% in an XYZ timeline. So that is what we're trying to figure out and to acquire and to seek out. Compounders. And what we want to avoid are essentially companies that I refer to as crap or disgusting dividend-paying companies. Essentially, how I can sum it up, as you can see on your screen right now, an investment choice, it could be a stock or an ETF that leads to the loss of money over time. When you invest into a crap company, a crap stock, say you buy into it and it's $20 today. 5 years down the road, it's going to be worth $10. And no, not because they did a stock split and they're helping you out, but just over time, it just keeps declining and your portfolio is in the red 50, 60, 70%. What we want to do as value investors, as smart investors, as XYZ investors is to avoid crap companies. They are not good for you or for me. And this is the checklist that we're going to be referring to. You can go ahead and pause the screen, take notes, take a screenshot. More often than not, of course, there's a lot more criterias, metrics that we want to look at, but this is just like a 5 minutes or less quick checklist that you can refer to see if a company is worth investigating into or doing a deep dive or researching further. If they don't meet these 5, move on. Please just move on. What I'm saying is, if they do meet all 5, the probability of them being a really good company, the chances are in your favor. The 2 companies that we are going to be referring to today, because it's going to be a working example. Number 1, the right side of your screen first, is going to be Microsoft. I am a shareholder of Microsoft. I have been looking to sell out of them because they've been pretty flat for the past 365 days, but they are still a very good, delicious dividend compounder in the grand scheme of things. So for the time being, I'm just holding on to them, but I think they're a really good example of a good quality compounder. And on the left side of your screen, we're going to be looking at Hanes Brands, ticker symbol HBI. They're in the business of underwear, bras, and I think maybe socks. And I get it. They're not in the same industry or sector, but this is just for illustration and example purposes. Hanes Brands is going to represent a crap company. I had to try really hard to find a company that no one watching this video is invested into because I get it. Whenever I talk smack or negative about an investment that someone is invested into, they immediately click dislike on my video, leave me a hate comment, start making fun of the way that I look, my voice. We get personal. And I want to avoid that, right? So I picked Hanes Brands. If you are invested into them, I'm so sorry. But you, me, and the whole world that's watching this video, we'll all agree and know that they are a crap company, objectively, by my definition and standard. So the first criteria is we need to see the revenue growing. This is what investors refer to as the top line. If the revenue is not growing, then you know that the company is fundamentally struggling for one reason or another. They're losing market share. Customers are just choosing not to go into their restaurant or buy their soda cans anymore. On the other hand, if the revenue is increasing, then it shows you that the company is expanding. It shows you that the company is growing. And it shows you that the business is not just squeezing margins or cutting costs, but rather the business is showing proof of demand of whatever it is that they're selling to the consumers. I do want to point out that not all companies, especially when we talk about the mature ones, they're not going to be able to grow their revenue every single year. Case in point, when we think about Warren Buffett, his two biggest investments that he made in the last 3 months, really funny, is beer and pizza. However, Warren Buffett also owns about a third of all the shares outstanding for a company known as SiriusXM, which is funny to me because SiriusXM's revenue is pretty much flat and one could argue even declining. If the revenue is not going to be growing, then that company needs to be improving their fundamentals elsewhere, or their profit margins need to be improving, such as an operating margin going from 20% to 21%, 22%, or they're improving their free cash flow, net income. All that to say, if the revenue is not improving year over year, then you got to start doing all of this crazy jumping through the hoops and loops and shaking your booty to figure out if it's still a good company. So keep it simple. The revenue has to grow year over year. All right, so let's take a look at Microsoft's revenue situation. Fiscal year 2020, they posted $143 billion. Gosh, that is outrageous, which is a growth of 13% from the year prior. Just look at how it grows. My goodness gracious, this is insane. Well, if you want to see it visually, because some people are visual, look at that. In the trailing 12 months, they posted $261 billion of revenue. On the other hand, when we take a look at Hanes Brands, in 2021, they posted $6.8 billion, but since then, it's just been declining and pretty much flat since 2022. You want to see it visually? It's just as ugly. And by the way, they had a really solid brand in their portfolio known as Champion, and they decided to sell it. They sold it like a year and a half ago. Bad decision. And checklist item number 2, the earnings per share, aka the EPS, needs to be growing year over year because it is proof of the company's profitability and scalability. When you think about the EPS growth, it shows you that the company is improving its net income per share. So when you think about net income, that's what investors refer to as the bottom line. Meaning after you pay for all of the expenses, overhead costs, insurance, your employees, the money that's required to buy the supplies or the ingredients, after you pay for everything, what is your profits? You want to see a company be profitable, correct? So another way that you want to look at the EPS is how much profit per share are they generating? And that's why it's important. And I also put a call out right here that it's important for calculating the PE ratio. Other people refer to it as the trading multiple. I don't exactly like the PE ratio. It comes into like a 1% deciding factor, but a lot of the investors out here, they do like the PE ratio, and that's why it's also important. And something else that I want to call out is if the revenue, the one that we looked at just before this one, if that is increasing or growing year over year, but the earnings per share is pretty much flat or even declining, then it shows you as an investor, you need to investigate a little further because it could signal they're having cost issues, margins are being, compressed, or even worse, they're diluting the shareholders by issuing more shares. All of that, red flags. So to keep it simple, earnings per share should be increasing year over year. Microsoft's earnings per share, fiscal year 2020, they posted $5.82. And since then, look at how it is growing year over year. I'm gonna say this, in 2023, it only went up by 2 pennies from the year prior, $9.70 to $9.72. But in the grand scheme of things, if you want to look at it visually, it is growing and it is going in the right direction. Trailing 12 months, we're talking about $12.48. On the other hand, with Hanes Brands, when we take a look at their earnings per share, this is disgusting. Negative 21 cents, and then the next year they flipped positive, and then negative. If you want to look at it visually, it does not get any better. This is disgusting. Now the next one, I'm sure all of you are going to resonate with, because I don't know about you, but I am a dividend growth investor, and it is really important. And that's going to be the dividend growth rate. A dividend that is growing year over year, so much more important than you think. Because when you think about it, a dividend that is growing is literally the direct output of strong financials and them kicking booty in their operations. It's the consequence and the result of a good business, as I wrote right here. If a company consistently grows their dividend, it shows you as a potential investor that their revenue, their EPS, their net income, their cash flow, everything is going solid. Because a company can't sustainably keep paying out a dividend if their profits and their cash flows are non-existent or decreasing. So a rising dividend or a growing dividend shows management's confidence in their future earnings. If they know their future looks great, then they're going to raise the dividend as well. And that's why the older that I get, the more I appreciate the dividend growth rate. I think that's really important. But also, if the company has a solid dividend profile, then it's going to attract a wider audience of people that might be potentially interested in them. It's going to attract the growth investors, dividend growth investors, income investors, people that are retired, people that are ugly, people that are short. More and more people will like a company if their dividend profile, the growth rate, the yield, if everything looks good, it's going to attract more people. And then another point that I wrote is the higher the dividend growth rate, the stronger the fundamentals need to be. Because a weak company cannot sustain a 8%, 12% dividend growth rate. If their profit margins, if their earnings, if their free cash flow is growing at a rate of like 1%, that means their dividend growth rate might be 0.5% or even 1% if they're really risky. So if a company consistently increases their dividends, then it shows you that they have strong financial health. Not always, but I would argue for the most part. Microsoft's dividend profile payout ratio is 26.7%. The dividend growth rate is 10%, meaning this number right here, how much you get paid in dividends, is growing at a rate of 10% year over year. That is absolutely bonkers. Love them or hate them, Microsoft is quite literally the definition of a dividend compounder with cheese. What you are seeing is the visual depiction of their quarterly dividend payments just increasing year over year. Beautiful. On the other hand, when we talk about Hanes Brands, their dividend profile, it says not available. Well, what's going on? Well, in November of 2022, they paid their last dividend and said, we have to cut it. They do not pay a dividend anymore. They are a dividend-cutting company. That's the biggest red flag. Like when your workplace is the most toxic environment ever, but they always say the phrase, we're like family here. Dysfunctional. Get the heck out of here. When we scroll down to look at their dividend growth situation, I mean, it was pretty good up until 2017, where the dividend remained flat, and then eventually it just went bye-bye. And that's because their financials and fundamentals were not there. Moving on to point number 4, the free cash flow per share. And we break it down to a per share level so it's easier for you to compare this business to another one in according to how many shares are outstanding. Because if a company has like, I don't know, 100 million shares outstanding and their free cash flow is like $1 billion, and then there's another company that only has like 50 million shares outstanding, but they also have the same amount of free cash flow. When you break it down to a per share level, then you can see that one company is obviously better than the other. But let's back it up a little bit. Why do I care about the free cash flow? It shows the sustainability of the dividends and business flexibility in what they want to do with the leftover cash, to reinvest into the business, to acquire a competitor, to increase the dividend payouts. And let's emphasize this point. What do you mean by sustainability of the dividends? So when it comes to dividends, the company affords to pay you, the shareholders, that dividend from cash. Now, in an accounting perspective, it is paid out from the retained earnings. But in actuality, what happens is the cash flow, the free cash flow is what pays and generates the cash to afford to pay out those dividends. So the free cash flow is really important when you want to measure a company's dividend health. Because when you look at the retained earnings, a company can manipulate the numbers, their balance sheet, and their data in order to afford that dividend, to have that dividend payout ratio be sustainable. But if the free cash flow doesn't back it up, then you know that it's probably not a healthy dividend overall. Now on paper and in the GAAP realm, the dividends are paid out from the EPS, quote unquote. However, it's the free cash flow per share that's actually paying out those dividends. And one more point that I want to make on why a free cash flow is so important to the business and the flexibility thereof is they could use that extra cash to pay down their debts if they want to. Free cash flow, I don't think you guys understand, is such an important measure of financial health and business operations. The free cash flow is crucial. Now, on the other hand, if the business that you were evaluating, you're looking at it 2019, 2021, 2023, what you see is a declining free cash flow, that is the definition of a walking red flag. That's literally like someone telling you that British or English food is the best in the world, a cuisine. You gotta be kidding me. Walking red flag. Incorrect. When we take a look at Microsoft's free cash flow per share, it's going from $5.89 in 2020 to what it is today of $9.37. Outrageous. On the other hand, when we consider Hanes brands, it used to be $1.12 in 2020, and then it went up to $1.57. Beautiful, phenomenal. I think that's when the rage for Champion, the sweaters, the sweatpants, everyone wanted a pair, and I can see why their operations were thriving. And then look what happened the following year. Negative $1.35 of free cash flow per share, and then it went back up into the positive, and now it's back down to 64 cents of free cash flow per share. Not good. The last checklist item is going to be their debt situation. And a good way to figure that out is the debt to EBITDA ratio. What you want to see in a perfect world is a ratio of under 3. Let me back it up a little bit. So the debt to EBITDA is you take their total debt and you divide it by their EBITDA. And it basically tells you, all else being equal, according to their operations and their cash flow and how much money they make, if it doesn't grow anymore and it's just flat, all else equal, it would take them that many years in order to pay off the debt by using their earnings before the interest, taxes, amortization, depreciation, what have you. So the magic ratio of 3 means that it would take a company 3 years from using their earnings to pay off their total debt. Now, what you have to understand is that debt is not all that bad and scary if you understand how to manage it. And I do want to point out that in certain industries and sectors, high debt is just a part of the game. It's just the landscape. So when it comes to businesses like utilities, banks, REITs, etc., this rule can be a little flexible. But what we want to see at the end of the day is that the debt is under control, that it's manageable. If the company is over leveraged, then they're going to have a tough time when any setback hits them right in the face. And a point that I want to emphasize is debt is not scary if the company or business in question have healthy financials. If they have adequate amount of free cash flow, good net income that's growing year over year, debt is not that bad. Some people, investors, and YouTubers refer to all debt as being bad, but if you understand the fundamentals and the industry itself, it's not that bad of a situation. Because think about it. Most of you watching this video, you likely have a mortgage, right? For 500 grand, 900 grand while you're paying off your house. So if you yourself were a business, your total loans, your total debt situation, pretty scary, right? But when you think about it on a day-to-day operational basis, while taking into consideration your salary, your income, and your paychecks, if you are able to pay for that mortgage every single month, then it's not that big of a deal, right? Likewise, when you think about loans, associate that with businesses as well. However, I do need to also say it again, if the company is drowning in debt, then they're going to suffer. Microsoft's debt to EBITDA situation used to be at 1.2 in fiscal year 2020, which I think is still phenomenal. However, since then, 2021 onwards, it's now under the ratio of 1. That is absolutely crazy. Trailing 12 months, their debt to EBITDA ratio is a 0.7, meaning it would take Microsoft approximately 8 to 9 months to pay off all of their loans and debts based on everything else being equal. And on the other side of the spectrum, Hanes brand's debt to EBITDA ratio, outrageous. I mean, it went from a 4 to a 2.9, which they were finally under that golden ratio of 3 or less. Great. However, it rebounded up to a 7, a 3.9, and it's now currently 3.9. Not good. And if you are currently experiencing a tough time and you're going through a storm, dude, I feel for you. I've been there before. It absolutely sucks where you feel miserable, you're angry all the time, you're tense, you're stressed out. It's terrible. However, I do want to remind you that it's not always going to last. The storm eventually does pass. Tough times don't last, at least forever. You might be going through this for, like 9 months or even years, but eventually you're going to get through it. There is light at the end of the tunnel. You got to just keep trucking along. And that's why I wanted to give this public service announcement. Every man on planet Earth, we can throw in women as well, every human being needs to have a hobby, a place or an activity or an interest where they can just blow off steam and just relax or to enjoy their time, whatever it is that they're doing. If your form of a hobby is tuning in to your favorite political commentary guy and you drinking alcohol and you're feeling more angry afterwards, that's not a hobby. Their job is literally to make you more outraged, to make you angry and divided against your fellow human being. I cannot stand political commentary people. They piss me off. But anyways, you need a hobby. Because if you're going to be spending 50, 60, 70 hours a week at work, at a job that you hate or stresses you out, or if that's the cause of your, negative emotions or whatever it is, whatever's causing you pain or that hopelessness, you gotta have a hobby where you can just enjoy yourself. At least maybe even like 30 minutes a day. It is so beneficial for your mental health. I am telling you. Do jiu-jitsu, do road biking, hiking, board games. For me personally, these days I started to explore the realm of Warhammer. I know, absolutely nuts. It's a huge universe, overwhelming, and I finally decided between two that I have to pick, I guess by the end of the week, which one I want to, claim as my army. It's the Space Wolves and the Grey Knights, but that's neither here or there. I just wanted to let you know if you're going through a tough time, I feel for you. It sucks. Hang in there, stay strong, have a hobby. I'm not saying that a hobby is going to cure you or make your life entirely better and get rid of all 99 of your problems. But I'm not saying that. But what I am saying is it's going to help alleviate some of that pressure, that stress, those dark thoughts in your head. A hobby is so good. Anyways, if you're anything like me, I guess the stock market is one of your hobbies, which I find to be engaging, fun, proactive, and something where I can always look forward to. Unless you're invested into speculative crap, where I assume you're more angry by the day, like, why is it going into the red? And that's why subscribe to this channel, because we try to find, deep dive, and endorse, I guess not endorse, but we try to talk about high quality compounders that are here today, here tomorrow, and where your initial investment in them should grow and expand and compound over time. Do not invest into speculative crap. Please, I don't even know you and I'm trying to look out for you. And if anything, if you don't want to heed my advice, you don't want to pick up a new hobby or go back into a hobby that you've been putting on the back burner, then at least take like a 10-minute break sometime today or sometime later on this week. Do some deep breathing, meditate, and just stretch. When's the last time that you genuinely got down on all fours? Okay, you're dirty. I'm not talking about like that, okay? Keep that, this is PG, okay? Keep it kosher. When's the last time you went down on all fours and you stretched your quads, your calf, right? Get some stretching in, do some deep breathing. I love you guys. Stay safe and good luck in the stock market. Peace.